Welcome back to The Explainer. Today, we're diving straight into one of Europe's absolute juggernauts, UniCredit. We're talking about a massive financial institution with a 127 billion euro market cap that is currently sitting right at the dead center of the continent's biggest and honestly most aggressive banking battle in decades. We're going to unpack a super fascinating situation today where sky-high, totally record-breaking financial performance has actually collided head-on with investor anxiety. Okay, let's dive into this. Our roadmap for today covers 6 key areas. First, we'll look at the UniCredit paradox, then the Commerzbank takeover. After that, we'll weigh the record profits against capital costs, check out some bullish analyst price targets, walk through 5 major roadblocks, and finally, we'll ask if this is going to create a true European banking champion. Section 1. The UniCredit paradox. To really understand why this story is blowing up the financial headlines right now, you've got to appreciate the unbelievable momentum this bank has built. They've delivered 22 consecutive record quarters. I mean, that kind of consistency is almost unheard of in the incredibly volatile world of global banking. Look at these first half 2026 numbers. Net profit hit 6.29 billion euros, which is a massive 24% jump year over year, and revenue came in at 13.66 billion. But your main takeaway here? That 24.4% return on tangible equity. That puts them right at the top in Europe. Operationally, this bank is just a relentless cash-generating machine. But, here is where the story gets super weird. When UniCredit announced these spectacular July earnings, the stock didn't soar. It didn't even hold steady. It actually dropped about 5%. So, if the bank is literally making billions and completely crushing its efficiency metrics, why in the world is the market punishing them? Well, that is exactly the mystery we're solving today.
Section 2. The Commerzbank takeover. The answer to our mystery is sitting right across the border. UniCredit is currently locked into a high-stakes, originally hostile takeover bid for one of its chief German rivals, Commerzbank, and it comes with a staggering price tag of 43 billion euros. And listen, UniCredit isn't just dipping its toes in the water here. They've already locked down roughly a 48% stake, and CEO Andrea Orcel is targeting absolute 100% complete control of the German bank by the fourth quarter of 2026.
And guys, the pieces of this puzzle are moving incredibly fast. Let's just walk through August 2026 alone. On August 6th, the CEOs of both banks met. Just 5 days later, on August 11th, formal consultations began, which was a huge deal because it marked a shift in Commerzbank's stance from blocking the takeover to actually helping facilitate it. The very next day, internal documents leaked showing the European Central Bank sees no substantial reason to object, basically leaning heavily toward approval because they really want a more integrated European market. And by August 17th, the German government, which had been pretty hesitant, officially opened the door to discussing the sale of its remaining 12.7% stake. The regulatory and political dominoes are literally falling perfectly into place for UniCredit. Section 3, record profits versus capital costs. Now, what's really interesting about this slide is how we have to balance those immense, record-breaking profits against the hidden, massive costs of putting a deal like this together. First, the good news, right? UniCredit is so confident in its internal profit engine that they recently upgraded their full-year 2026 net profit guidance to a jaw-dropping 11.5 billion euros, which is being driven by incredibly strong fee and insurance income. So yeah, they clearly have the cash flow. But here's the hidden cost I mentioned. In the banking world, the CET1 ratio is basically your ultimate financial safety net. It measures a bank's core capital against its risk-weighted assets. Now, UniCredit currently sits at a very comfortable 14.3%. However, consolidating Commerzbank would drain that ratio by a severe 200 basis points, dropping it down to an estimated 13%. So yes, it's still technically above the regulatory minimums, but it's a massive hit to their safety buffer. And that brings us to the direct, real-world consequence of that capital strain. Because UniCredit has to hoard all this cash for the integration, they were forced to shelve a highly anticipated 4.75 billion euro share buyback program. For investors, canceled buybacks mean less cash in their pockets. And honestly, that is exactly what spooked the market and caused that 5% drop we talked about earlier. Section 4. Bullish analyst price targets. So, retail investors might have panicked a bit, trading the stock down around 84 to 85 euros in Milan and $91 OTC. But Wall Street? They are telling a completely different story. If you look at the major institutional consensus, there are precisely 0 sell ratings out there. JP Morgan, Barclays, and Goldman Sachs are all maintaining strong buy ratings, with price targets pushing well past the €100 mark. They're looking at a very healthy 7 to 17% upside from current levels. Bank of America has even gone so far as to label UniCredit a top pick. They highlighted that the stock trades at a 2026 price-to-earnings ratio of just 9.3x, which is noticeably below the broader Eurozone banking average. With an earnings per share consensus sitting at a very strong €7.37 for 2026, they're arguing that this current market discount is just completely unjustified. Wall Street is basically saying the underlying profit engine is way too strong to ignore. Section 5, 5 major roadblocks. So, the crucial point is, if the analysts love it and profits are at record highs, why isn't this just a guaranteed slam dunk? Well, pulling off a cross-border merger of this magnitude comes with 5 formidable roadblocks, and they are making the market hesitate. First up, integration execution risk. Merging two vastly different corporate cultures is like trying to force puzzle pieces together that don't quite fit. Second, political headwinds. Commerzbank has warned this merger could lead to up to 11,000 potential job cuts. That's over a quarter of its workforce. And navigating German labor concerns is incredibly tricky. Third is the capital constraint we already talked about. Fourth is regulatory uncertainty. And finally, stakeholder opposition. Because even with the CEOs talking, union resistance remains incredibly stiff. And to dig into that regulatory uncertainty just a bit more, while the European Central Bank totally wants a unified European market, Germany's local financial regulator, BaFin, still holds a ton of the cards here. They actually criticized UniCredit's initial approach as being too aggressive, and they're demanding very credible mitigation strategies regarding corporate governance, transparency, and anti-money laundering checks. UniCredit absolutely has to get BaFin on board before this formal review wraps up in September or October. Section 6, a European banking champion. Let's zoom out to the macro picture here for a second. This entire play is being driven by CEO Andrea Orcel's historic ambition to break the old mold of fragmented national banks and create a unified, absolute European banking powerhouse. And if he can successfully navigate the regulators, appease the unions, and somehow avoid a massive cultural clash, the transformational upside is crazy. Consolidating these two giants would create an estimated €1.2 billion in synergies. That's a massive amount of unlocked value and scale that neither bank could ever dream of achieving on their own. Which leaves us with one massive question to ponder. Right now, the broader market is pricing in the risk, while Wall Street analysts are clearly pricing in the reward. As always, please remember this explainer is strictly for informational purposes, and you should definitely do your own research before making any financial moves. But as you watch this historic deal unfold over the next few months, ask yourself this. Will Andrea Orcel's super bold €43 billion gamble become Europe's greatest banking success story, or will it go down in history as a massive cautionary tale of financial overreach? Thanks for joining me on this explainer, and I'll catch you next time.